Hi, everyone. Thank you very much for joining us. This is Stanley Dash of TradeStation, and welcome to Trading Futures with TradeStation. Since I'm on here solo, and we did a sound check before, and it seems like everything will be okay, just give me a yes in the chat area if you can see the title slide and my voice. Rodney and Rory already responded. I appreciate that. Okay, excellent. Mitch, thank you very much. Good. So let me make a couple of preliminaries here and let you know what you can expect in this hour or so that we'll get to chat a little bit. Trading futures with TradeStation. My goal in this presentation is to, I know we have people with a number of different levels of experience. I certainly saw that in the poll that we took, or in the polls that we took. And we'll try and hit some ideas on a number of those different levels. And we want to integrate the idea of the futures markets, what's in TradeStation that specifically relates to futures, what's in TradeStation that's generic, but it can be used for futures, and get you thinking perhaps about ways that you can approach the futures market, the kinds of things you can do in TradeStation that'll make your futures trading easier, more efficient, and ultimately, we hope, more profitable. Now, a few things. There are one of my colleagues, a few of my colleagues are logged on, but in particular, my colleague Eddie is logged on. You probably see his name in the top of that list. Eddie is from our brokerage area, Eddie Gordeau, and Eddie is capable of answering questions that you might have specifically regarding account procedures, account opening, brokerage policies, things like that. So if you do have any of those questions, if they come into the chat, Eddie will try and answer them there, or he may get in touch with you, put up his email and get in touch with you afterwards. But he is from our brokerage side, and I wanted to let you know he's there, and he'll listen in, and if he can help out, I'm sure he will jump in via the chat or with an email. Most of you know that these presentations are for educational purposes. Please be aware of the fact that I want to present some concepts related to trading, related to analyzing the futures markets, and of course trading the futures markets. And please don't take these as recommendations in any way. Hopefully they will get you to think about your trading, think about different concepts in market analysis, and give you a little better understanding of how some of the futures markets work and different perspectives on those markets. There's more information like that in the important disclosures PDF, which is in the chat, in the documents area at the right, and I just pushed it into the chat as well. Those of you who are veterans know that there's quite a bit of material in the documents area at the right, and I threw in a few extra things. Don't go stressing yourself over that right now, but there are a few things I'm going to mention in this presentation that have additional documentation, additional study material on other places on our website. So I threw a few extra links into the documents area in the right. The other thing that I threw into that documents area is a PDF of the slides. It'll be in the documents area. I just put in the chat. You can get it now. You can wait till the end and decide if it's worth your effort. But if you do want a copy of the slides, they're available as a PDF, and you're welcome to have those. Okay, I think we're ready to get into the meat of it here. I want to present TradeStation as our business model being built, or using the TradeStation platform being built on three legs. And I often present this way, to be honest with you, in certain sales presentations, but I think it really puts in perspective the underlying themes for a lot of the things I want to talk about here today. First of all, data. Those of you who are veterans with us know that we have a tremendous historical database. You're going to see some of that in our discussion today. And of course, real-time data, and you'll see that in our discussion today as well. So we provide the data. We have a commitment to the quality and speed of that data. But the data is only good as the analysis we can do with it. So what kind of analysis can we do with it? Well, of course, technical analysis is our forte, but we'll also touch on some things that may straddle the line between technical and fundamental. Conventional and custom analysis. Some of the things you'll see in here today are pretty conventional, right off the shelf. Other things are things that I tweaked around a little bit, and we'll make those. They're already available, most of them on our website, but I'll let you know where you can find those. That's where some of those links come in that I mentioned are in the documents area. And of course, we can also do strategy testing, and you'll actually see some back tests today. The The back tests we'll do today aren't so much for the purpose of finding a perfectly tradable strategy, but they're more for the purpose of testing a broad concept or doing some comparative testing. I'm going to talk about that a little bit as we pursue this. And of course, our data is for analysis. Our data feeds the analysis. The analysis is only good if we can act on it. And we do provide excellent tools for trading. We'll take a look at some of those, including the new chart trading directly from a chart. I do have that set up in here. So we'll take a look at some of that in this presentation as well. Now, the presentation doesn't go quite in this order necessarily, maybe a little bit, but I do want you to keep in mind that these are the three elements of putting together our infrastructure, putting together our logistics for good trading. Do I have the data I need, and do I know how to get it? What kind of analysis can I do? What kind of analysis might I be missing that might be helpful, especially in the area of futures? And then, of course, how can I manage my orders and place my trades most effectively? So those three underlying themes will arise again and again as we cover different topics in this presentation. We do want to talk about the data first. In that sense, I will go in order. Do want to talk about the data first and let you know some idea. I'm going to switch back and forth, by the way, between these slides and the TradeStation platform. And I usually remember to click in the right place. And if I don't, I'm sure you'll remind me. But we do want to talk about what data is available in TradeStation and give you an idea of how to access it. So I'm going to talk to the slides a little bit, and then I'll click over to the platform a little bit. Clearly, individual futures contracts are available. I'm going to show you some examples in just a minute. We also have some symbols specifically for the stock index futures, for ES and YM, TF futures, the Russell futures, that are daytime only symbols. They cut the day down so it only reflects the conventional US daytime session. I'm going to show you all of this in a minute. We also have continuous contracts available. And when we discuss some of the challenges related to futures, we're going to discuss those continuous contracts a little bit more. I'm going to actually start that in just a minute. We also have something we call custom continuous contracts. And I'll illustrate that as well as we go into this next section. Now, in order to keep up with the slides and not get too seasick going back and forth, let me expose these next two bullets, even though these next 2 points I'm going to come to a little bit later in the presentation. Our database includes what I refer to as special basis symbols for stock index futures that help us track the basis. Some of you may know what basis is. If not, I'll give you a little foreshadow. Basis is the relationship between the cash market, the stock market in this case, and the futures contracts, such as ES or YM or TF for that matter. So part of our database are special symbols to help you track that arbitrage, that relationship more carefully. You're going to see those a little bit later. And we also have the availability to make custom sessions. Higher up in this slide, I wrote daytime only symbols. Well, many of you know that the ES futures, for instance, trade almost 24 hours. But the US equities market, certainly the prime session when all the volume is only 6.5 hours. So we have some special symbols in our database. We have some special symbols in the database that reflect only that daytime session. But we also give you the opportunity to create custom sessions. And you'll see that as well in just a moment. So let me click over to TradeStation. And let's talk a little bit about the data, and let me show you some examples in here. Carlton put forth a good suggestion, and that is something that we should forward. Well, I may be able to help you with a little bit of that, Carlton, as you see some of this, but your point's well taken. If you can see, you should be able to see TradeStation now. I have a RadarScreen window open just with some symbols. I just want to talk about the data. A couple of charts behind it that I want to show you. If you want to, you should have some scroll bars beneath the TradeStation desktop and to the right. There are also some toolbars that are part of the browser, so you can do a little resizing. you can feel free to change that around and make that look a little better on your screen, and of course you can use the scroll bars as well. I will even push this, maybe make this easier, I'll even push this font up a little bit more, so maybe that's a little easier to see. I do have some symbols in here, and I really just wanted to show you symbols so you get the idea of how the database works. As I said, I want you to know what's in here and also how to get to it. So I only have 2 markets up here, but I put up a bunch of symbols so you see our symbol structuring system. So you'll see ESU12, that is the individual contract that I mentioned, the E-mini S&P, the September contract, which is still the active contract. And then ESU12.D. Now that's one of the daytime only symbols that I was alluding to before. So the ESU12.D makes believe the day is only 8:30 to 3:15 Central Time. Now, if you're familiar with these markets, you'll know that that is the traditional pit session for the S&Ps, the original and traditional pit session for the S&Ps. So it is not exactly like New York Stock Exchange. It runs an extra 15 minutes, but that's the way the pit did and does run. So the .D symbol runs 8:30 to 3:15 Central Time in order to parallel the pit. Any of the other trading does not appear on the chart. Now the @ symbol, that @ prefix, as Carlton just noted in the chat, the @ prefix is the continuous contract. Here's the issue that we often have with futures. Any individual futures contract, each individual futures contract is liquid for a very short time. In the case of ES futures, it may be liquid for a quarter, a calendar quarter. But in the case of crude oil futures, it may only be liquid for 4 to 6 weeks, when it really has a lot of depth, a lot of open interest, and a lot of volume in that particular contract. In fact, crude oil is the market I put beneath ES futures in this RadarScreen window. So how can I make any longer term charts if I really only have liquidity for a month, or even if it's only 3 months? Well, the way we do that is we create continuous contracts. We append the newest active contract to a history based on the prior contracts when they were the most active. And that's the concept of a continuous, and that's what the @ prefix does in our database. Now you'll notice there's also an @ prefix ES.D, which is daytime only. It's that same .D symbol. Now you'll see another @ symbol, I'm on line 5 here if you can see my reference rows, @ESU12. So there's an @ sign, okay, so I know that means continuous, but it says ESU12, so I know that that's pointing directly to the September 2012, the current active contract. Well, that is what we call a tradable continuous. So it is a continuous contract, but it points directly to the tradable, meaning the U12. That may help you a little bit, Carlton. It's not exactly what you're asking, but it may help a little bit in some of the work that you do. And the same thing for the .D, @ESU12.D, a continuous contract pointing to the September, daytime only. Now let's take a look at these charts. I'm going to come back to this RadarScreen window in a minute, so I'm going to hang on to it there. But I just wanted to make this point. The chart on the in the top section is, if you can see the status line, it may be a little small, but if you can see the status line, it's @ES, so it's the continuous contract, ES futures. It's a 30-minute chart. Well, @ES is the full 23.25 hour session, 23.75 hour session. And it's a 30-minute chart. And this rectangle is meant to draw your eye to what is the conventional daytime session. So the bars that are colored magenta are from 8:30 to 3:15 Central Time, the traditional daytime session. But this chart is giving us the full session. Now down here, this chart, the one on the bottom, is @ES.D. .D means it's only daytime. The chart is using, now .D does not come from the exchange. We construct it on our end, and we construct it such that it only knows, it thinks the market is only open 8:30 to 3:15 Central Time. So it makes a chart only including that data. Any indicators would only calculate from that data. Any strategies would only run on that data. And the reason I highlighted those two rectangles is because I didn't go exactly bar for bar, but the section that you see in magenta here is the entire day from this yellow vertical. The yellow vertical is the start of the day, right through that bar. This is this. Scale may be slightly different. So if you're looking for a chart that will only build based on the day data, it's in our database. You can do that. It's the .ds. We have those for the stock indexes, and again, it was an attempt to take that electronic and fit it to the traditional high volume part of the day when the pit was open, 8:30 to 3:15. You'll find it for ES, you'll find it for YM, you'll find it for TF. I believe for some of the other indexes like the mid cap as well. I didn't go through each one. I see a couple of questions. First of all, Gary, the answer to that is yes. If you build a strategy, if you make the chart at ESU 12, it'll go back, or at ESU12.d, it'll go back as far back as you load into the chart. And then if you're automating on it, it'll fire off orders into the September. Beware, be honest with you, beware, it won't automatically roll to at ESZ12. You'll have to do that. And I'm guessing that's a little more what Colton was asking for, which is not a bad idea, but another question. Jesse, the reason it says 9:30 to 4:30 is because this computer's on Eastern time. And the default for any chart is local time zone. The computer time in this computer is US Eastern time. So 9:30 to 4:15 is the hours. And I pushed my brain so far as to say 8:30 to 3:15 out of respect for my friends in Chicago. Okay. EJ, I'd have to double check that for you. Eddie may be able to check on the margin question for you or get back to you with something on that. Okay. The next active contract after the September is the December, is the Z, Harvey, and that's why the next one would be Z. That rollover should be next week offhand. Should be when the quote-unquote official rollover is. I will check that date. Yeah, we can double check that for you. I'm sorry, I was just trying to look at the calendar at the same time, and I don't want to mess up the video. This will be archived, Peter. Okay, let me get back to what we were talking about here. I do want to go back to this RadarScreen window once more. I'm going to spend a few more minutes on data, but then let's dig into some other stuff. I did have the crude oil up here, and there's a reason I had crude oil up here. This doesn't have a .d, so even though it trades approximately 23.25 hours, if I did that right in my head, we don't have a .d for this. I'll show you an alternative for that when we get into some charting and analysis in a moment. But I did want to show you, if you can see row 11 in here, at CL equal 103XN. Well, that's kind of a bizarre symbol. The custom continuous contracts allow you to build the rules for how the contracts are appended and how the data is managed. In other words, if I use at CL, it uses TradeStation's rules for when one contract is dropped and the next one is added and how they roll over. At CL equal 103XN, it's a little bit of a bizarre moniker in there, but that is because I designed how I want the contracts appended and how I want them rolled over. Now, that's not a matter of you doing the coding. It's a dialog box. And in fact, it's a very easy dialog box to use. You can look that up in the help. We have some videos on it. You don't have to write formulas. It's a set of dialogue, and you just check off the way you want the contract handled. Okay. Kathy, the .d is for ease of use. The .d becomes very handy. You'll see in a few minutes when we start to talk about things like market internals, when the night data means nothing to me, and it makes a much neater chart, much more convenient for me in some cases. So it's a better graphic and it's ease of use. The aspect of easy language is going to be important. I'm going to talk about that. Hang on to that question. That's good. Okay. And the reason I used 103, Cletus, is because I have it roll 3 days before the last trading day, not 7. Trader's choice, and you can experiment with all of those. The Cletus's question was on the code in here, the @CL = 103XN. Each one of those characters means something and how the data is appended and handled, and we're kind of getting into a little debate about what's quote-unquote better or not, and there's a little bit of trader's choice in there on the way you handle the data appendage. Okay, so let me go a little bit further. I'm going to go back to the slides, and let's see if we can move from the data. We talked about individual contracts, daytime only, continuous contracts, custom continuous. We will talk about the basis symbols and the custom sessions in a few minutes. That's going to relate back to some of the other questions like Kathy's. Now, the few things that I want to mention, I already alluded to some of this. The most active futures are virtually 24 hours. They may be 22, 23 1/4, 23 3/4. There's some that are shorter than that, but they're still pretty long. So we have to deal with this issue of these markets are open longer than we're going to sit here and stare at them. We will have to make some decisions, and this is a little bit different than trading stocks, and that's why I emphasize this. If you have experience in Forex, you may be a little more familiar with the idea. We're going to have to deal with when do I trade and when don't I trade, and how do I manage all that. And then I already mentioned futures mature as frequently as every month, and we talked about continuous contracts to help address that. Continuous contracts have been done by futures traders for many, many years. So in that 24-hour day, and again, the markets are not exactly 24, but close, so just work with me on that one. The thing I would suggest that you do, and I'm going to give you some examples of that in just a moment, would be to take a look at, to consider what time of the day, let me rephrase that, from what time of the day should I draw data for my analysis, and what time of the day should I do my trading? This relates back to Kathy's questions and some of the other things that we were talking about. Meaning the market may be open more hours than I'm going to trade, so I need to decide, okay, here's the time when I'm going to trade, but does that mean I ignore all the other data? Maybe I need to analyze the data even during the periods during which I'm not actively trading. So let me check my notes. Let me click over back to TradeStation, and I'll show you a couple of other things. Okay, here is, in fact, let me maximize one of these. It might be a little easier to see. That's pretty good. That is corn futures. If the status line is a little small, it's in the upper left. It says @C, so it's corn futures. You can take my word on that. It's a 15-minute bar chart, and I just made a 15-minute chart, so a few days fit on the screen in a nice visible manner. Those yellow verticals I emphasize so that you see each day. So this is the beginning of a day and the beginning of the next day. So this is today's action. This is current. And you'll notice the volume histogram along the bottom. Now you'll notice there's a distinction in the volume histogram that certain times have a lot more volume than other times. Well, those happen to be the times when the pit is open. Electronic trading has overtaken the pits, but the hedgers, the grain industry, the traditionalists, the volume still focuses on those hours. And now it does push out a little bit more, maybe ahead of that time, especially on report days. The exchange is trying to adjust to that environment without completely undermining the traditionalists and the people who've been in the business a long time. But you can see that the period that I painted magenta is that period, and it runs, by the way, and they make me do this in Chicago time, 9:30 to 1:15 Chicago time, or 10:30 to 2:15 Eastern time. That's a traditional pit session. These are 15-minute bars, and you'll see the volume just completely dominates during that period. Okay, so the question comes up, and this is what we're driving towards. This was corn. You'll see the same thing in wheat. I don't think we need to rehash it too much. Same thing in beans. I put the three corn, wheat, and beans, grains, and oilseeds up here just to give you an example. Take a look at it also in crude oil. So this is crude oil futures. This is the full day, the full NYMEX day. The magenta bars are the traditional pit trading hours. Look at where the volume is. Sure, it's open all night, but so what? Maybe I'm being a little too cavalier. It's open all night, but look at the relative volume. Enormous difference. Enormous difference. Now, that doesn't mean we can throw away what happens at night and make believe it doesn't happen, but it does bear words of caution on trading during those times when the volume is minuscule relative to that daytime. Now, the reason I had two different charts is because the bottom one is also the crude oil continuous contract. They're both 10-minute, by the way, if I didn't say that before. On the bottom, you only see the daytime. On the bottom, you'll see, for instance, this break and this break. You can kind of see that more. I'm sorry, am I in the right spot? Let's see. Let's use the pointer. Okay, so this day is this day. I'll use my workspace pointer. If you don't know what that is, I'll show you in a second, so I know I'm lined up at the same time, chronologically, at least. See if we can make it a little easier to see. There you go. They may not be perfect, but I won't spend too much time clicking around. This period is this period. Now, how did I cut out the rest of the data? By the way, that was the pointer tracking. You can get that from the drawing menu. And when you use workspace, that means all the charts on one workspace will have a vertical cursor at the same time marker, the bar with the same time markers. It's very convenient for lining things up the way I just did it. I'll shut it off for now. Now, in the bottom chart, you don't see the green bars because the bottom chart is only that daytime session. And that bottom chart was done using what we called custom sessions. I alluded to that before. Custom sessions can be built. I mentioned before, it does not take any easy language. It does not take any programming. It's just a dialog box. So I created a custom session that I called New York Energy. And that gives me a daytime session, what is traditionally the high volume session. And I cut out the rest of the day. Now let's get back to this question, because this is really the important one, of data for trading and data for analysis. Here's my point, and this does relate back to a couple of the questions that were up there. It's very tempting to say, well, and it's very reasonable, I shouldn't just say tempting, it's very reasonable to say, I'll only trade during the high volume period. Maybe extend it 30 minutes either way, whatever you think is appropriate. But clearly, this is the period that you want to be involved in as a trader. But then it becomes tempting to say, well, I'll throw away the rest. And that I would caution you on doing. Because what I found, and I'll show you a very simple example, what I found is that it's best to do the analysis on the full day's data, even if you restrict the trading to only the liquid period. Now here is the example. On top is that New York session crude oil 5-minute bars. I'll say that again. So on top is the day session only, when that traditional high volume part of the day. It's 9 o'clock to 2:30 New York time, by the way. And you'll see a strategy on there. It's a simple 20-bar moving average crossover strategy. That's it. The only extra rule, no stops, no targets. I'm not worried about the performance. I'll make my point in a second. The only extra rule in there besides the moving average crossover is for we conceived it as a day trading strategy, so we get out at the end of the day. We don't hold overnight. So this really does not use any of the nighttime data. However, in that first chart, it also means, because I'm using my custom session, it also means that I do not have, my moving average does not see any of the data at night. So first thing in the morning, first thing meaning as this session sees it, when we open at 9 o'clock in New York, this moving average is not taking into account anything that happened overnight. It's picking up from yesterday afternoon New York time. Now, the alternative in the bottom chart is the full at CL 5-minute chart. It's the same bar, same interval, same symbol, but it uses the regular session data. However, it restricts the trading to the same time period. So it still only trades during that liquid part of the day, but the calculation for the moving average is based on the full data. So when you hit the morning, the moving average is different. Same rule about getting out at the end of the day, which in this case means getting out at the end of that daytime session. Now, I went back in these charts. Let me double check because I was making sure these were up to date earlier today. I cut them off August 31st, so I cut them off at the end of August just to get us a week or two separation. And I went back 1 year, so both charts are the same. Now, this one on top, here's the performance report for the one on top. 1 second, I'll make sure you can see it. Okay, I'll even push the font a little bit. Okay. So this is a year of trading, 5-minute bars. Remember, it only sees the daytime. I did take into account commissions, by the way. They were in here. There were 2,000 trades. Yeah, I'm not advocating the strategy by any means. So you see it lost $9,100 over a year. That doesn't mean throw it in the garbage. That doesn't mean it's great. It doesn't mean it's evil. It's just a test, and I want to make my point. The same rules with a different calculation of the moving average. Different calculation meaning different input data. More trades, and it almost broke even. Now, I'm not concerned right now about making or losing money. I'm trying to get an understanding of a relative evaluation of the trading strategies, the merits of what data should go into my strategy. Now, if you stop and think about it, I said a 20-bar average on 5-minute bars. So once we're an hour and 40 minutes into the session, that's 25-minute bars, the trade should be the same. So the difference between the two strategies was really what happened in the first hour and 40 minutes of each day. And you can see that's a stark difference. This one actually did more trades, but was roughly break even. As opposed to this, it did a few hundred less and certainly lost a lot. So here's my point. I did some tests similar to this, by the way, on Forex. Here's my point. It's useful in something like this, in a case like this, to have your analysis done on all the data. In this case, and there are a few questions, Kathy's and others in there. In this case, the ideal, in my mind, is to use the full session chart, but write into the easy language that restricts the trading only to certain hours. I prefer that to just restricting the chart to certain hours because that's going to change the calculations. Okay, I know Eddie's been helping out with some questions. I'll just look real quick. If they're off topic, we'll circle back around to them. But I do see that Mark asked a question about a 20 bar moving average crossing over the price. There's a supplied strategy called moving average cross LE and moving average cross SE, and you can set the input to a 20 length, and it's based on it's a simple long entry and short entry based on a 20 bar average. Well, the 20 is an input, so you can adjust that based on a 20 bar average crossing over. Now that won't be a 20-day average unless you make it a daily chart. But if you create a daily chart and then use those strategies that are supplied with TradeStation, moving average cross LE for long entry, moving average cross SE for short entry. Robert, I'm going to come to some of that in just a minute. Okay, so let's see where we are. We talked about the data for analysis and data for trading. Let's talk about the concept of market internals. The market internals are really something that futures traders have stolen from the stock market. But they help us. Let me explain what market internals are. If you've never heard the idea, you probably hear them more in the context of stock traders and more broadly stock market analysts. The idea of market internals, we look at indexes and we get obsessed with indexes, whether we're trading futures or whether we're trading the ETFs like spiders and Qs, or whether we're doing just broader Dow theory analysis on the indexes. And we sometimes forget that the index is not really anything. The index is the result of a calculation on 500 stocks or 30 stocks or 2,000 stocks. And in itself, it isn't anything. Market internals reminds us that the market, can we see inside the market? Can we see what's going on inside the market? So people who study market internals look for, if they're trading the Russell, how many of the 2,000 are rising or falling? Or if they're trading the S&P, how many are rising or falling? Or the NYSE advances, declines. The old expression we used to have years ago was whether it was a stock market or a market of stocks. And we tend to think of it as a stock market, and we forget sometimes that it's a market of stocks. That's what internals are all about. So decline, advances, declines, I'm going to show you some in a minute. Net ticks, issues above, below a moving average. I'm going to show you all of those in just a minute. So if you'll bear with me, I'm going to click back over to TradeStation and show you some examples of this idea of using market internals. Although these have been, these are drawn from the stock side, as I said, they're certainly used by futures traders quite a bit because they are just as relevant in helping us identify the ebb and flow of trading and market direction by looking inside the stock market, looking inside the trading. I put a few of them on these 2 pages just to give you an idea. We literally have hundreds of what I'll broadly call market internals, and I'll show you just a few examples in these next few minutes. One of the ones I want to show you is what's called the net ticks, or sometimes called the cumulative tick index. And it's telling us how many of the stocks in a group of stocks, maybe of the Dow 30, maybe of the NYSE, are on upticks versus downticks, or the net on upticks versus the net on downticks. Advances, decliners, NYSE. And we have others as well. Here's NASDAQ, advances, decliners. 52-week highs and lows, NYSE, NASDAQ. That's the number of stocks making new 52-week highs or making new 52-week lows. We might refer to the VIX as an internal, and that's a debate that when nerdy technicians get together over cocktails, they go into that debate for a while, so we'll skip that one at the moment. Here's some more detail on some of the other tick indexes that we have in TradeStation. We don't just have the tick index, we have a lot of different tick indexes. The Russell, S&P, NYSE, which is the traditional, NASDAQ, ARCA, Now take a look at a comparison in here. The chart on the left is daytime only. I'll make it a little bigger. This is daytime only ES. So it's ESU12.D. I could have used the @ES. I didn't for no special reason. The .D I did use intentionally. Now the reason I used it intentionally is that if you are using market internals in your futures trading, you really have absolutely nothing to look at from overnight. The whole idea of market internals is that something is going on when the market is open. You're looking at advances, declines, net ticks. This chart, in fact, in the last 15 minutes when those futures are open, those extra few minutes, this is a 2-minute bar chart, by the way. When the futures are open, those extra 15 minutes, there's nothing down here because the stock market is already closed. So in this case, the .D is a real convenience, and I don't feel that I'm losing anything in using it. Now, I'll tell you the bands that I have set up in here, and I'll tell you what the symbol is in here. Yeah, Mitch asked about specific levels, but let me see what I can find for you, what I can suggest. First of all, this particular symbol is $tick SP. I'm using, in that chart, I'm using this one, $tick SP, which is the net ticks on the S&P 500. Which means that that symbol, the values for this should never exceed positive 500 because there are only 500 issues in it. And more likely you're going to reach peaks at other levels. This is just the 2 minutes you're only looking at today, but you see that peaks tend to come in, peaks and valleys in the 200 to 300 range or negative 200 to 300. What I've been experimenting with, these horizontals here where you see the yellow dots, those are at 90% of the previous day's high and low. I don't have a strategy built around it. It's what I've been experimenting with. It's kind of almost a relative volatility, if you will, because I'm using the prior day's high and low net tick reading to gauge it. My theory would be that you sell high tick levels. Look at this in coordination with other technical analysis. This is not a standalone strategy, but it's going to give you a sense of what's going on internally. Sell the high levels, buy the low ones. We had a hard break this afternoon. It wasn't really all that much considering, but we did have a pretty good break, 6 or so points in the last, say, hour or so. So you got a lot of these low tick readings. Well, as I said, it's not a standalone strategy. It should be coordinated with something. I put a simple moving average up here just to give us a reference point. I did not put any overbought oversold oscillators, which would be an interesting thing to look at in coordination with this. Now I want to show you the one other chart. Got a few more things to go through here, so I'm going to pick up the pace just a little bit. This one is YMU. So this is the Dow futures, also a 2 minute, just because that's what I made in here. And in this case, let me maximize it so you can see it better. In this case, I'm using $tick, $TICK, which is the NYSE ticks. That's the most traditional measure of net ticks, is the NYSE tick. The TradeStation symbol, $tick. Now we do have a Dow Jones tick. Why would I not use that with the Dow Jones futures? Personally, I don't like it that much because it's only 30 issues. It locks too easy. If you get a strong up day or a strong down day, you miss some ebb and flow. So I think 30 issues is not enough of a sample, and that's why I stay away from the net ticks on the Dow Industrials. Net ticks on the S&P 500 I think is fine. It's got 500 issues. You're rarely going to smack positive or negative 500. But the positive negative 30 happens quite a bit, and I just think you lose nuance. I haven't done that much work specifically with the Russell, but it's in there. And if you want to see those again, I'll be glad to pop this up here again. Dollar tick RL for the Russell net ticks. Dollar tick SP for the S&P 500. Dollar TICK is the traditional NYSE tick. Dollar TIKND for the NASDAQ 100. Those are the ones I find most useful. I think are the most interesting. Okay. Let's see. Somebody mentioned finding these. I'm trying to give you some of these symbols, but if you take a look in the symbol lookup, a little magnifying glass up in the magnifying glass and like a ticker tape up here, and if you take a look under index, you can do, I have two suggestions for you. Do some creative searching of the description here. You know, type in net ticks and see what comes back up. But also, and you're going to see this in the next section that I want to show you, take a look at TradeStation Native Index. No, I don't know who thought up that name, but those are indexes that we calculate on our end and available. So we have some indexes, we have hundreds of these market internals, breadth indexes that we customize. You're going to see some of them in the next example. This will give you the full list. Okay, let's take a look at this this workspace. I thought this was maybe this is a little repetitious, but I'll show it to you quickly. I have it all set up already. This is the ES futures daytime only, so at es.d. It's a 3-minute bar chart. There's no special reason it's 3-minute. I had some set up as 2-minute and some as 3-minute. There's no special reason for that. And what you see down here is it's a $VOLSPD. Now that's the net difference in volume on issues up and issues down for the S&P 500. And people have a habit, because of the acronym, of calling it the volume spread, which it, I guess, sort of is. But the SP is not for spread, it's for S&P. It's the net volume of issues advancing versus issues declining on the S&P. There are lots of these in the database, and you can tap into those, use the symbol lookup. And what I did is I created a simple strategy just to test an idea of trading the futures based on this this symbol, this net volume on the S&P being above or below its moving average. Now I'm using a 25-bar average. I'm using a 25-bar average, and I restricted the trade. Now think about that. The nighttime data is out of here, so I'm not fully into today's data for 25 bars. 25 3-minute bars, 75 minutes. What I did when I made this little strategy, just as an example, as I said, no trading until after 10 o'clock Eastern. Well, in 3-minute bars, that means I'm at least 10 bars into the day. So I'm trying to account for the fact that, yes, I have no real data here until I get 25 bars in, but I don't want to completely wait an hour and a quarter if I get some signals. So I'm going to wait till I'm at least 10 bars in and then start taking the signals. And this was interesting. I went back a year on this also, ending August 31. I cut everything off, you know, as of August 31st, so you know, a little over a week ago. And it was interesting. There were no stops in here. It gets out at the end of every day. That's the only rule, was no overnights, because overnight doesn't exist in this mindset. And there are probably drawdowns that are not acceptable. Remember, I said I didn't put any stops in, so be cautious on that. But it does show some promise, some net profitability. One thing that I think is interesting also is that 41% of the trades were profitable without real trade management. So I think that shows some promise for the concept. We're talking about using market internals. What can I get from the stock market? The net ticks, the difference between the volume on rising issues versus falling issues. Those are the kinds of things we want to be able to use to see more, to see better into the futures market. Now here's another example of using internals, and this one, I'm going to throw you a link on this one. Let me see, give me 1 second. There's a market breadth study I put in here. Okay. I just want to make sure I put that link in, and I want to tell you what it is. This is one of our analysis concepts papers. Every month we publish a white paper on a different aspect of technical or fundamental analysis. Usually there's some easy language in there. We go through some educational discussion and some testing in the hope that it'll put you in the right direction on thinking about this. And a young lady who used to work for us in our group, unfortunately, she moved on in her career, but she did some nice work on this concept of a market breadth oscillator. And it's in that, you can read the whole paper and download the items at that link. And I'll remind you of the link later. But take a look, let's say, here's the NASDAQ futures. Here are the NASDAQ futures. And this is a 1-minute chart, daytime only, the .D. If you can see in the corner, I know it might be small, at NQ.D. Now, I threw out the night session because I'm not going to trade at night. This is only based on the internals during the day. You could use the night symbol, but then this oscillator would be empty during that overnight period. Okay, and you can see if you look at some of the spots where we trend, of course it's going to be trend oriented, but I want to show you what's behind it in just a minute. I don't mean to make you dizzy here. Take a look. I loaded in a lot of data, which is why the scroll bar is very active. This started to turn positive right at the end of the day here. Now, I don't know whether you would have held a position overnight or not. I won't even get into the debate. But right around here is when you started to turn positive. You started to turn green on the oscillator, above zero, at the end of the day here. And obviously had tremendous follow through after that. You'll find plenty of bad signals as well. But the idea is there something behind this attempt to use market breadth? This started to give us negative readings. This should be up to date. Yeah, this is today. So you started to get a lot of negative readings later yesterday. Didn't really break, but you had a lot of negativity in there, and it really didn't follow through till earlier today. And then, of course, we had that downdraft, like I said, the last couple of hours. Now, I want to show you what this is based on, because this is really a very nice piece of work, and it's really some interesting things in our database. Part of what's in our database is statistics, indexes, it's in the data, on the number of issues in an index that are above or below their 10-day, 20-day, 50-day, and 200-day moving averages. So when this was constructed, I hope you can see this. This was constructed, you see the NASDAQ futures data, the other data you don't see, but it's using the 10-day, the number of NASDAQ 100 issues above the 10-day average, the number above their 20-day average, the number above their 50-day average, the number above their 200-day average to profile the NASDAQ. The other pieces that are in here in this workspace also use equivalent indexes. But these are some of our native indexes. This is some of what we do on the server side to give you new, different, unique internals and ways to look at them. Now, I found it very interesting when she was doing this research because I assumed, well, you're looking at the number of issues above and below their day moving averages. These are 10-day, 20, 50, 200-day moving averages. But we're looking at it on a 1-minute chart. I didn't think it would be valid intraday, but it seemed to be. My guess is that it's the weak hands that flop first. Anything that's above its 200 or below its 200 is going to be there for a while. And it's the ones that are flirting around their 10 and 20 that are the ones that are pointing at the next near-term direction. More detail is in that market breadth study. I know there were some questions up there. I'm going to keep going for just a minute. Actually, there were just two or three other things I want to show you in here. Actually, let me take a look and see if the questions are germane. Uzi, your questions are good ones. Up-down volumes we just talked about. Glenn says he uses some of the internals. Kathy, our data is cleaned on our end. So it's not the ESU12 and ESU12.D will be simultaneous. You won't see a speed difference. You won't see a price difference. They're going to come through with the same speed and be exactly the same. Obviously, one updates the full session and one only updates part of the time. Okay. Do they match each vendor? I can't say. Theoretically, they should, but different vendors have different ways of time stamping. There is not necessarily an absolute right or wrong on that. What we work towards and what you should be thinking about, hopefully with us or with anyone else, is consistency in the data and in the methodology. For instance, all our bars are time-stamped by their ending time, always in TradeStation. Now, there are other vendors who time-stamp by the opening time of the bar. Frankly, that's not necessarily good or bad. It's just a different way to look at it. And as long as it's consistent, you understand what's in front of you. That's really what's most important. Okay. Take a look at a few other things. I'll talk a little bit about basis. There were questions on that, and I do want to mention. I'll mention crack spreads real quick too, since I did some of the work on that, so I may as well get it in. I'm sorry, I'm going back to the slides. I didn't mean to do that to you. This word basis, if there are any futures veterans out there or anybody from the hedge side, you certainly know what basis is. In short, when futures traders talk about basis, they're talking about the relationship between cash prices and futures prices. Whether they're talking about the corn basis somewhere in the Midwest, or they're talking about the basis for a sugar transaction, or they're talking about a basis for loading agricultural products on ships in Seattle for export. Basis is always this word that is the relationship between cash prices and futures prices. So in the case of stock indexes, we're talking about the relationship between the futures price and the cash index. Obviously, we're not talking about corn or sugar or soybean oil. So sometimes it's known as the premium in stock indexes. Maybe it's going to be known as the discount if this continues, but the reason it was known as the premium is because the futures were always higher. The ES futures were always higher than the cash index until we were upside down on interest rates versus dividends. So now the futures trade at a discount because interest rates are lower than the dividend yield. It's still known as the premium in the stock indexes. So what we often track is fair value, the theoretical basis, the actual basis. In other words, traders look and see, are the futures and the cash market, the stock market, are they tracking properly? Do I think there's an inefficiency in there that could be exploited? Now I'm going to skip some of the detail on this, but just be aware of the fact that that relationship, the theoretical model on that relationship, is based on dividends and interest. And you can study up more about that. It's based on dividends and interest. Now what we have, I'm going to skip the cost of carry model. It's dividends and interest. Trust me on that. We have a number of symbols in our database that automatically give you the real-time relationship between cash and futures. Now I know a question went up before about the theoretical value or the theoretical basis. That's not in TradeStation. You can get that from external sites. It does not change intraday. It's the same value for the balance for the entire day. These symbols give you the real-time calculation as the cash and the futures go tick, 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 tick. Now, this is on the slide, which is the PDF that's in the documents area, so you don't have to worry about writing this down. I'll make the PDF available again, but it's in the documents at the lower right. And we can take a look at some of the ideas behind using this. Here are those symbols again, but you already saw them on the slide, so I threw them into into RadarScreen here. Here's the one for the S&P, $ESINX. Our friend Hubert Centers uses this a lot. He always talks about it in his morning market briefings. You may have heard those. But you see, it doesn't trend. It doesn't do anything. It just looks, a little bit like my EKG, which is why I take those pills. But it's just a value. This is the real-time relationship between the cash and the futures as the market is ticking. Well, there are a number of approaches to analyzing this or to putting this into use. One approach that I often look at, I'm going to scroll back. I'll find you some good ones, and of course there are spots where it didn't hold up. One example of using this, here's the theory. If the cash market and the futures market get out of line, then I can expect the big players to push it back into line. The arbitrageurs are likely to push it back into line. Well, if the futures market is cheap relative to cash, they're going to buy futures, sell cash, sell stocks. And if it's the other way around, well, they're going to act the other way around. So one theory is when this is relatively low, be a buyer. When this is relatively high, be a seller. Now this is on 3-minute bars, daytime only. You can't trade this way at night. Get out of the end of the day. This is a very aggressive style of day trading. But you'll see it catches some interesting points. Not all the trades are winners by any means, but it does catch some interesting points for day trading purposes. There are people who interpret this in different ways. My general theory is to use a volatility band around this value. And that's what I'm looking for it to poke through this volatility band. That's why you see them getting closer together, because it's based on the volatility of that relationship. Also, I avoid trading this first thing in the morning, because first thing in the morning, the futures market opens like that. It's actually already open. The stock market takes a little time to grind out some new values, because in the S&P, until you get at least, I won't argue with you how many issues, until you get the 50 biggest cap issues open, you're really not getting good readings. And that's why on the first bar of the day, you can get some very wild swings. So I usually wait roughly a half an hour into the day, 15 minutes to a half an hour into the day to get signals. But we're talking about this whole idea of exploiting market relationships. Can I understand something about the futures that I didn't understand before? Why are the futures trading 1409 or whatever the price may be? I scrolled back, or 1420s at the end of the day today. Why are they trading at that price level? Well, where's the cash market? What's the relative price relationship? And, of course, is there something I can exploit in understanding that? Craig, those volatility bands are mine, but if you email me, I will give them to you. I've made them available at other presentations, so I have no qualms about that. Now, another interesting relationship. Now, this one gets a little bit thicker, so I'll just going to introduce this very, very briefly. This is what's called the crack spread. And I did do a study on these. There was a white paper on these, so I want you to, you can go back and look at these if you're interested in it. And this is taken right from that study of the crack spread. For those of you new to futures, what's the crack spread? As I often say, it's not a plumber joke. The crack spread is the relationship between crude oil and gasoline and heating oil. Those big towers that refine crude oil are called cracking towers. They crack it, distill it, and the yield from crude oil is gasoline and heating oil, and of course some other distillates. So the idea in this study was, can I look at that relationship, even if I don't trade that spread, can I use that spread to trigger trades in, let's say, the crude oil futures? That's what the study was about, and I encourage you to take a look at that if it's an interest of yours, to take a look at that white paper. The point I want to get across here is that understanding a little more about market relationships is going to help you understand futures. You know, technical analysis is generic and fractal. Technical analysis that I do on one market is the same as another market, is the same as another market. But markets have different characteristics insofar as they're driven differently. They have different players. They even have different trading hours. And that makes a difference. So I might not change my moving average. I might use the same moving averages, but I need to understand what data is going into those averages. Being able to use market internals is a big edge. It's really a big opportunity in markets. You have access to data that tells you something about what's going on inside the components of that index. Those are the kinds of things that a trader should take advantage of. Doesn't mean you'll use everything, but understanding it is going to give you a better view on the market. This was the study we did on crude oil, by the way. This was a 5-year study, and we were using the crack spread to trigger crude oil trades. So there were some big swings in the equity. I know you see a lot of profitability there, 150,000 on only 88 trades. Now there were also some good trending periods in the last 5 years. There were some choppy ones too, but there were some good trending periods. But anything that follows trend that's profitable on 59% of the trades is kind of an interesting result, because trend followers always struggle to get their number, the percent profitable, somewhere north of 40 at least. And when you start to get well above 50, that should at least open your eyes. Again, we didn't put in stops, we don't put in exits, we're not pushing this strategy on you. But when I see this, I say, well, do I have a market relationship that even as a private speculator I can exploit, even though I'm not a professional oil refiner or shipping company? Okay, the last thing I want to mention before we just show you some order entry is commitments of traders. And I want to show you this partially because I'm in the midst of writing the next analysis concepts white paper, and this is the subject matter. So I've been for 2 weeks I've been up to my ears in this, so now you're going to be stuck with it too. There's something in the futures, in the area of futures, we have something called commitments of traders report. Let me tell you briefly what it is if you're not familiar with it. As part of its oversight of the markets, the government collects data on those participants in futures who hold large positions. The definition of large is up to the commodity regulators. It's public information. It's on their website, but it's up to them whether it's more than 100 contracts or 400 or 500. It's different in different markets. But they want to know if you hold a position above a certain size, they essentially want to know who you are, how big the position is, if it's above a certain size, and what is your role in the industry? Are you a private speculator? Are you a money manager? Are you a hedger, meaning an oil refiner or a farmer or a food processor like an ADM or a ConAgra or a Tyson? Now, based on those reports, we get an idea for the open interest in a futures market of who's got what. Not who by name, but who's got what. So the commercials, as you see on the slide, the commercials are hedgers. Big hedgers. In other words, big enough to be reporting their positions, like ExxonMobil or ConAgra or ADM or a bank that may be hedging interest rate exposure. Non-commercials are what we sometimes call the smart money. Those are money managers, hedge funds, CTAs, large speculators, non-commercials. And then the non-reportables is everybody else. Anybody whose position is not big enough to be reported, that's everybody else. But based on the breakdown of these numbers, based on the breakdown of this information every week, we get an idea of who's doing what. It can be tremendously valuable information. I'll show you just one piece of it. The rest of it, you'll have to wait about a month to see the rest of the paper. But here's the corn futures market. I'm going to use this graphic in the paper, so you'll see it again, because this is the spring, late spring, summer rally we just had in corn. It's a daily bar chart. So this green line is telling us where the non-commercials are. Who are the non-commercials? Smart money. And I hesitate to use that term because it's trite, but it's hedge fund managers, large speculators. Well, what does this rising line tell us? They're starting to get long. The line bumped up, bumped up, bumped up. They're increasing their net long positions down in here. At the same time, here's the total open interest. Everybody in the market, everybody, is going down, meaning this group is getting longer, but overall, the marketplace has people leaving, has net money leaving. So there's really net short covering in the market. This first turnaround here wasn't people piling money in, wasn't smart money coming in, it was smart money getting out of the wrong way. And then finally, you see it all comes together. Smart money is increasing its net longs. Open interest is rising. It's confirming what we see here as the chart moves up. William, you should see this crude oil chart with the corn chart with a white background. It looks okay on my screen. I can maximize that if it's any better to refresh it. Otherwise, William, you may have to refresh your player. I didn't maximize it because I really only focused on this part of the chart. Commitments of traders data is part of the TradeStation database. Futures traders use this information to get an idea of how the different players in the market, commercials, hedgers, non-commercials, which were large speculators, non-reportable, the smaller guys, how they are positioning themselves in the marketplace. And obviously the goal is to follow the smart money. The smart money is wrong plenty of times. But if we use these tools together, and that's what I'll publish in the paper, if we use these tools together, we start to see, I'll use my technical analysis, what's the trend? Is the trend confirmed by money coming in to back up that trend? This kind of information is only for futures traders. Now, I've gone on about 15 minutes too long, but I do want to show you a few things regarding order entry. This is actually, this is a little crowded here, so let me see if I can show you this here. Okay. This window we call the matrix window. You're probably familiar with it if you have TradeStation. You certainly should be. This is an outstanding window for order entry. This is the S&Ps. We're in no man's land at the moment, but this is the S&P futures. Trading-wise, we're in no man's land at 5:43 Eastern. Here you see the bids. Here you see the offers. Order entry is one click. Oh, we're in no man's land, so I can't give you the click. Okay. I'm not open yet on gold either. Gold won't open for a few minutes yet. Okay. One of the things that I want to show you is these attach OSO, and this is something that I do when I'm day trading, and I'm not at the moment, but when I day trade, I always use this. I day trade a lot using the premiums that I talked about, using some moving averages like these that I talked about. I always have a stop that goes in immediately with the order. Now, the way I have the stop set up is that it's $250 when I'm using ES, 5 points. That's not magic. That just means if my system's down, it's there. If I get a phone call, it's there. If I have a problem with connectivity, it's there. And on any one lot, even if I make a mistake and I get hurt for the 250, I'll certainly survive that. Whether you make it 100, whether you make it 500 per contract, it doesn't matter. My point is that this allows me to have a stop in. I don't have to think about it. It's in. Then I can move it. I can make it tighter. I can move it with the market. I can enter a trailing and get rid of the other stop. But that's what's really important, is to have that. Take a look at the OSO and OCO information. And the last thing I just wanted to point out, and this is pretty new in TradeStation, is the ability to trade right from the chart. The ability to trade right from the chart. In order to do this, there's a toolbar button that says chart trading, so you have to enable it, and then you will get an order bar here. Your orders will display. Your orders will display, and you can click and drag those orders within the chart. Okay, John. Oh, that's right. TF is open, so let's give that a try. So I can at least show you the tools. Let me change the matrix as well. Thank you, John. And I wanted to show you both because that way you'll see one and the other. I know I'm squeezing this a little bit. Okay, I'm not going to bother changing the settings in the matrix right now. Hang on a second, folks. Let me be a little neater about this. I apologize. We don't need to see all that much of the chart. That'll be more useful, I think. Okay, so 836. I'm going to put 836 price. I'll put in a bid for 1. Okay, now you see I have a buy order for 1 at 836. Here it is in the matrix. I attach OSO, exit stop only. I have an exit stop in 835. If I want to change my exit stop, tighten it up, I can click and drag. That's what I was saying before about it's in. And I always do that when I place an order. Oh, Bob, do you have an alias now? I always do that when I place an order. Now you'll notice that the order I placed, the 836 bid, I dropped right in. It also came into the chart because I've authorized the chart trading. So if I click and drag here, I can actually move that order right in the chart. Now I'm going to put it high enough so I'm going to get filled. Notice it kept the proximity of my stop, and now my stop is in also. The matrix, chart trading, the order bar, which I did not show you before, they're all reading your account. They're all reading your same order flow. So I placed my original order in the matrix. I changed my OSO stop using the matrix. I moved my entry order using chart trading. And I could also place or cancel orders through the order bar up on top. You can set, let me actually clear these out. Let me clear these out. I'm going to use the matrix just to do this. I'm going to click cancel all. If you can see where I am in the lower right part of the matrix, cancel all. So now my stop is canceled, and I'm also going to close my position. I'll make this a little bigger again so you can see it better. And we'll change this to a bracket, one limit. Let's make it simple. One limit, one stop. And I'll place an order to buy. I'll make it 836.5. Buy one. Now I'm placing a bracket. Now the two orders you see in green are will only become active if my buy order is filled. You see my buy order in gray. If my buy order is not filled, my exit orders never become active. If I cancel the buy order, the others two are canceled right away. If I want to go to the market, now it's trader's judgment on going to the market. Glenn was asking, what do I do with the stop if I want to sell, say, at the market? Okay, I'm going to push my price up, and I'll lift the offer so we get filled. So now I'm filled, and now you see my two active orders. Well, this button that says close is a quick way to get out of the open position. It says close. I closed it. The orders were canceled because the orders were contingent on having that open position. Now you can enter the orders independently as well. Let me uncheck this, and I decide I want to enter an order to buy one. So I'll just buy one. I'll make it a marketable limit order, and I'll place a stop order down here. So now I did them independently. They're still valid. Be careful with the discipline. That was my point about using the OSO, is to have the discipline. And now if I close out, order's gone. We have quite a lot of documentation and videos about using the matrix. The chart trading is pretty new, but there are some videos about using the chart trading. I suggest you take a look at those, and I suggest you use the simulator. That's what it's for. I think the best use of the simulator, in my opinion, and I'll be very frank with you, the best use of the simulator is not learning how to trade, it's learning how to use the tools. And for that, it is outstanding. Okay, I think we've been through the gamut, and I ran about 20 minutes over as it was, but you guys have stayed with me, and I appreciate that. I do want to mention that Dan Passarelli, a noted options educator and trader, will be my guest on the Spotlight On series next week, September 18th. That information on that is in that, also the live webcast schedule, and you can actually click right on the slide. And it'll open up another browser tab or another browser window for registering for that. Dan does some really interesting work on options. He's going to talk about managing options adjustments, and I went through his material with him last week, and it is right on target. It is about how to adjust positions when they go right and when they go wrong. And he's very candid about the upside and downside of making too many adjustments. So he really does understand the options markets. So I hope you'll join us for that. If anyone is new to TradeStation and you have an interest in opening an account, we would certainly love to be able to provide you with our services. You see the information on the screen, and of course, if Eddie has anything else to add in there, he's welcome to put something in the chat if he wants to put up his direct email address. Eddie, you're welcome to do that. All right, we are going to archive this, and I think we're going to offer this same material again, which means I either have to book it for longer or shut up sooner. But I appreciate everyone sticking with this. And if you need to get a hold of me, I'll put up an email address. The best way to get a hold of me, I'm going to put up my group's address, and you can just make it, to Stan. But this box is the one that doesn't get the spam. That's my group where we publish those various analysis concepts papers, and you probably know my associates Fred and Eric who do a lot of work on those as well. Okay. Here's a study that Eric did on ticks, the net ticks. We got some questions about that, and you'll also find here's the PDF one more time of the slides that were up here. Once again, thanks again, folks. Bob, thank you for your help and your suggestion on TF, and I hope we'll see you at another event soon. Take care.